What's up, Tim? How we doing?
Hey, good to see you guys. Happy Monday to you. It feels like it's been a little bit since I've seen you.
I recognize the background, though. I believe you were up in the chalet.
I am. I'm in.
See?
Yeah.
I'm starting to know your backgrounds here. He's got like 50. So, you slowly start to narrow them in. But
well, you too can have 50 homes if you use Market Structure Edge.
There you
go.
Maybe.
Hold on.
Nothing's guaranteed. Nothing's guaranteed.
Little humor there, everybody. Yes.
Yeah.
Tim, you have an extra spare room there, right? I'm coming through.
Absolutely, we do. Come on over.
All right, let's get into the action. Of course, in the markets, it's been tough. It seems like a lot of up and down moves, high volatility. Is it fast trading out there, Tim? What's going on?
Well, yes, it is. The whole setup to the period into options expirations. I'm one of the few people who pays a lot of attention to those things because it's predictive. It will tell you what's going to happen. If you look back over 2022, 75% of the time, the market changed direction at options expiration. So you should probably know that. But one of the things that I look for is which behavior is leading the portfolios that I've got at Edge. And if you're new to listening to this, traders, this is how I think about the market, that there are different purposes and time horizons behind price and volume. And the purpose and time horizon will determine how the market behaves. And if you look at the math, 70 to 75% of volume comes from passive investment and fast trading, which Mitch just mentioned. Fast trading we think of as proprietary traders who have an investment horizon of a day or less. So if your investment horizon is very short, the market becomes volatile. It's that simple. Passive investment will make decisions that take time and days to unfold because it's very big. Vanguard said a month ago that 80% of the $8 trillion of assets that it's got are in models. They're asset allocation models. They're passive investment funds. And those things don't think about, well, what's the price of this and how much can I get and what's it going to do? They just move money. And that's what happened in the first part of the year. And it went where money hasn't been, into tech, creating a momentum trade. Momentum trades, by the way, are nothing more than prices moving away from you. What causes prices to move away from you? Somebody who doesn't care about the price. It's really that simple. And so when that runs its course, that's when you should beware, traders, that you should take gains and not chances. And you could see that at Edge. You could see in the first 2 weeks of the year, every one of my portfolios at Edge was led by passive investment behavior. There were momentum opportunities everywhere. In the last week, it all deteriorated to fast trading. So then your time horizons shrink and the probability of unusual moves increases. And then you hit options expirations when derivatives expire. I went wholly to cash by last Tuesday because I looked at the data and thought, well, if the market's topped, options are expiring, fast traders are leading, what's the probability that the market declines? Well, fairly high. And so those are things that you can know, traders, and you should.
Yeah, definitely. I mean, of course, we've been seeing the recession fears out there, or maybe soft landing talk. And I know that drives the narrative sometimes, but it looks like you've been looking underneath the hood, Tim, and seeing that the data is pointing towards more of that topping and staying within this channel that we've been in lately. Let's go ahead. Let's get into more of the momentum trades. These have been hanging on. The January effect. It looks like we ran into a small little wall last week, then bounced right back. What's going on with these momentum trades?
Well, I like to pick on the pundits. I think about folks like, this is a name that goes way, so Spencer Israel would know this name. So this is your test. So there was this fellow named Jesse Livermore who was very, I see Joel grinning. and keep in mind, folks, he met an untimely demise. So maybe quoting him isn't a great idea, but he said that you have to have discipline a clear strategy and a concise plan in order to trade the market. And he also said to anticipate the market is to gamble. It's better to just look at what the market's doing and see if it confirms what you think. And to put those two principles to work in what happened last week, think about how much punditry contradicted basic rational thought. If you're going to have a plan and a strategy and discipline, would you change your mind the next day? Well, of course not. And yet in the last 4 days, we were told, 3 of those days where the market was down, we were told, well, this is recession fears. And then on Friday, the market bounces. And then we're told, oh no, now we're seeing a soft landing. Minds don't change like that. That's not how the market works, people. That is not what the money's doing. Options expired Wednesday, Thursday, and Friday. And if you looked at what was occurring right into options expirations, you would expect, okay, there will be a big drop, and then Friday will be a pretty good day because there was short covering ahead of time. It will give people a chance to chase prices back up. Son of a gun, that was exactly what happened. So that's what you should know. Traders, if you're going to be involved in the market, understand its mechanics. Now, to get to momentum, Mitch, again, I think that the reason there was momentum was clear to me in the data. Money came into the markets again in passive models. People are still making contributions to their 401ks, and that money gets deployed into the things that everybody is underweight in their models. What were they underweight? Tech. So you could go trade. I'll tell you, they were just everywhere. You know, Shop, Roku, Roblox, Square. I could go on and on and on. These stocks delivered 25% gains, even in consumer discretionary. Crocs, I traded Crocs, and it was that was a great stock to trade. All of these were things that you could look at in the math and say, well, these are things that we can produce returns in. And here's how I think about this. I'll share my screen. So if you have not seen this, this is Market Structure Edge, and it's very simple. It's just, let's look at supply and demand. It's the only way to see supply and demand in stocks. You have to look at how trades execute, and there are a set of rules that govern those. But look at the momentum portfolio on the left here. So we just use the math. It's there on your dashboard. But look at this. Demand is very strong, hitting 10, and supply dipped down. There are 24 components in here. Information technology is the lead sector, and it's led by fast trading. You can know all of that like that.
So Tim, question though.
Yes.
So when we see this, and obviously this looks like from your scenario, like very bullish signals here, how do we know when to ring the register?
Right.
Because this obviously we've had a good move. You're talking about a Square 25% move in a couple of weeks.
Exactly.
Crocs a huge move. How do we know when to ring the register?
So this is where I think about three things: broad sentiment, BCD, just like your valve if you're a diver. So there's broad sentiment, there's context, there's divergence. This is divergence. There's an awful lot of divergence here, but let's think about context and broad market sentiment. So the context is new options trade today, by the way. So the set that expired last week, a new set will trade today. Tomorrow, the books will get squared on those two. So that's an important thing. 800 companies report results this week. Those can be very disruptive. So context, challenging. Momentum can work during those things, but you should be aware of that. Then let's look at broad market sentiment. So back at the beginning of the year, right at the end of December, I said I went so far as to say there was a 100% chance that the market would rise in January. And it was only because I could look at the broad sentiment and see that it was below this green line. Statistically, over the trailing 5 years, every time that it has been below that green line, the market has risen in the aftermath. So I would say, mathematically, the market was very likely to rise. Now, where is it? Well, here's options expirations. That's what those little green things mean. They tell us where they occurred. And here sentiment is it's at 7.4, and it has stopped rising. Statistically, every time that the market has been at 7.4, it has declined in the coming couple of weeks. So there's your answer, Dennis. To me, if the broad market sentiment tells us that the wave of money that came into tech is likely to slow down, now we have to beware. And if you look at the other side of the coin, the supply side, look at this. Supply is starting to move up. Demand has peaked. Those are the conditions that reverse the market. It doesn't mean that momentum trades won't work, but you have to be very selective now. Whereas you could just be kind of carte blanche in the preceding 2 weeks into where we are now.
So at this point in time, you're saying if you're sitting on these 25% gainers in Square,
Yep.
maybe now is the time to ring the register.
I would. Absolutely. Yes. And here's how you know, traders. If you look at, let's just take Square as an example. Here's how to think about supply and demand. I mean, this is very simple because I'm a simple guy. So here's here it's been hitting the ceiling at 10, and supply was at a deficit. Now supply has risen well above the trend. Well, that's your exit signal. If either side of the equation, the supply side or the demand side, change. If demand deteriorates, I leave. If supply increases, I leave. It's the divergence of those as a long trader that works. Now, if you wanted to shift short, you can actually start thinking about, I wouldn't short this stock until it's coming down close to 5. But if supply rises and demand falls, then you can reverse your trade. And you could make money both directions that way. But it's all about supply and demand. And yes, it doesn't mean it's going to happen immediately. I think in central tendencies, it doesn't mean that you can't have additional up days, but the probability of additional gains has diminished significantly, and you should move on to
your risk reward setup isn't as good as it was.
Exactly.
Exactly.
Yep.
Yeah.
Yep.
Hey, Tim, could you just go into a little bit, someone's requesting that little deeper explanation on bullish and bearish divergence?
So this is how I think about it, and the math is very good. This is what we do. I've been studying these math and using brains smarter than mine that we enlist, like Nate the mathematician, it's what I call him, to run data on what happens when supply and demand diverge, like this. So when demand is rising sharply and supply goes the opposite direction, if there's a divergence, a standard deviation of more than 1, it's one of the things we look for. The probability of gains is very high. So it's that simple. We're not looking for patterns. Patterns, to me, the trouble with patterns is they suppose that the same things repeat. Well, the market is constantly changing. The value of derivatives changes. The amount of money coming into or leaving the market continually changes. So the only constant, to me, is supply and demand. And so you don't have to worry about a particular pattern. Just look for that. And we apply math to it so that we don't have to do that. I don't want to hunt around. I literally just do this. I look at the momentum portfolio every day. This is what we put out there. It's how I think about it. And I probably go to the bottom. And I heard you mention this earlier, Dennis, Wayfair. I mean, Wayfair is 10 and has downtrending supply. It's that simple. I'll go look at those. I look at the amount of volatility that they've got. This is how much they move intraday. The Wayfair is very volatile.
Yeah,
and so,
big time.
If a stock like this take any of those. First Solar, pretty good stock. If that stock is down 2 or 3%, I'm buying it. Why? Because it has a probability of moving about 5% a day. And so maybe tomorrow it's up 3. So if I bought it when it was down 2 and it rises 3, I've made a very nice return. And it's a very high probability, low risk, low stress approach to the market. And that's how to think about supply demand divergences.
Tim, before we let you go, we just we covered your topics here. Just talk real quickly about Monday, obviously first day of the week, but Counterparty Tuesday.
So that's a term of ours, Joel, but we've been using it a long time, and it's not something that we've just made up. It's an observation. So there are five big banks, and there are a lot of counterparties. But here's your market structure lesson for the day, traders. So in the derivatives market, which comprises, by the way, about 20% of market cap, that's why a stock that reports results during earnings can go down 20%. I mean, if all of a sudden the implied value of a stock vanishes, well, the part that's tied to a derivative can also vanish. And there are parties that underwrite that. Tends to be banks. I mean, you and I could buy options That's buying and selling volatility, futures buying and selling volatility, the VIX buying and selling volatility. And there are counterparties to those transactions that organize them. And there are 5 big banks behind that. And there will be a series that expires. So they're backing those, and they're going to have wins and losses associated with them. And then a new series will trade. Well, what's the demand? No one really knows for sure. They're going to try to estimate it. That's what will happen today. Could be an up and down day because they'll try to sort that out. And then tomorrow, Tuesday, we call it Counterparty Tuesday. There's one every month. The banks are going to square the ledger. Did we win or lose? And that will lead to what happens on Wednesday. If they were losers, they have to sell assets and the market goes down. If they weren't, everything's level. If they undershot demand, the market can go up. So those are important things to know. And almost never do people pay enough attention to that. All the credit will go to, oh, people feel good about this or bad about that, or it's earnings, or it's monetary policy. None of those things are 20% of market cap. Derivatives are. So that's why it matters. I always watch these days very carefully for a signal about risk taking.
All right, team. I went to go ahead and threw up the link there for your 30-day trial. Get it now for Market Structure Edge. I did see a lot of you guys mention that you guys wanted to see Tesla. Well, get that 30-day trial. Go ahead and check it out. As easy as that. All right, that's going to do it for us today. Appreciate you joining us. Like always, Tim Quas. We'll be happy to have you back on, my friend. Have a good one.
Have a good week, guys. Good to see you. Thank you.
Take care, Tim. All right, let's get back towards the market. How we looking, Joel? We leaked.